Hello and welcome to this Magellan Infrastructure Fund update. My name is Mark Jordan from Magellan Investment Partners, and today I'm joined by Co-Head of Infrastructure and Portfolio Manager, Ofer Karliner. Welcome, Ofer.
Hi, Mark.
The first quarter of this year has been a bit of a roller coaster in equity markets. Double-digit growth in the first couple of months for infrastructure before giving some of that back in March. As a starting point, can you take us through what drove that strong performance in the first part of the quarter?
So really the key driver in the first couple of months, and particularly in February, was that halo trade, high asset, low obsolescence trade. Really, it's about a rotation away from the company's market decided, rightly or wrongly, we're going to be disrupted by AI into heavy asset type investments, companies. So again, utilities, infrastructure is clearly in that frame. So we saw a rotation to those assets that are undestructible, and that really helped. For us, it's really a catch-up. We've seen these companies perform pretty well over the last 12 months, but they've kind of lagged over the last couple of years, global equity markets, and we see this, really a return to them trading where they naturally should be in terms of absolute and relative valuations. So it's good to see.
The Iran conflict clearly has been foremost for markets in the last month or so, and really, riled markets. How has it affected infrastructure?
Yeah, well, we've obviously seen a ceasefire announced, which we haven't seen the impacts of yet, and it's not clear how long that will hold for, or if there will be a return to hostilities. But certainly the short-term impacts, or direct impacts, have been pretty limited. So airports obviously have been affected to the extent they have traffic coming out of the Middle East. All those airports have been shut or had severe restrictions imposed upon them. Then hence you're losing some of that traffic from those regions. There've been second-order impacts in terms of jet fuel shortages, particularly in Asia. They get a lot of their jet fuel out of the Middle East. So we're seeing companies like Air New Zealand and some Vietnamese carriers, SAS in Europe, restricting flights or cutting back flight schedules. Been pretty limited overall so far. Toll roads have seen some very minor impacts. Just at the margin, we've seen some shifts from cars to public transport. That's just numbers coming out of the public transportation usage. Historically, we haven't seen a big price response in terms of traffic, so it's probably more about people worried about shortages and trying to conserve fuel. So overall, again, very limited direct impacts so far. Secondary impacts are more noticeable. So first of all, inflation is the most obvious one. Higher fuel prices feeds into most things via freight, etc. So we've seen a push up in inflation expectations in the short term, important, not in the long term. Long term, that could lead to real rate increases. Now, most infrastructure companies we invest in can pass through inflation, so that in and of itself isn't a problem. But long-term inflation expectations remain anchored, and real rates haven't really moved that much. So far, we haven't seen a big impact. Again, should we return to hostilities, it become a more entrenched scenario. There's probably a bit more risk to real rates, but overall, we see it as a moderate impact.
What's been going on does show some similarities to what we saw in 2022 when Russia invaded Ukraine. What do you see is different this time?
Yeah, it's a good question, a question I get a lot. First of all, the starting point is very, very different. So I spoke about real rates impacting valuation. You go back to 2022, real rates were negative across a lot of the Western markets. In the US, we're kind of minus 1% real rates. Similarly in Europe, we kind of accelerated to 2.5% in a very short space of time. Real rates at the moment are around 2%, so already the starting point's a lot higher. The other thing to think about is the demand environment is very, very different too. So in 2022, we had a snapback from COVID. So all of a sudden, there's pent-up demand from consumers in particular. Saw an acceleration of consumer spending. So consumer spending growth is about 9% in the US, 4.5% in Europe, 11.2% in Australia in 2022. Compare that to US consumer spending about 2.1% last year. Europe was 1.3, Australia was 2.3. Very different demand environment. So you don't have that wave of demand hitting effectively supply chain constraints and then having the Russia-Ukraine war thrust on top of it. So the starting point, again, in rates is already a lot higher. The demand environment's very, very different. So a combination of the two of those mean we don't expect the same sort of response in markets that we saw. The last element is rate expectations. Again, real rates have remained pretty well anchored. Haven't really moved that much despite the war so far. We go back to 2022 and central banks were guiding for very low rates for very long periods of time, and people have pretty much baked that into valuation. So the starting point of valuations is also much more reasonable than what we saw in 2022. So we don't expect to see similar impacts again to that Russia-Ukraine type event.
There must, however, be some longer-term impacts as a result of what's going on, and conversely, on the flip side, there will also be some opportunities. What are you seeing from a longer-term perspective?
Long-term, it kind of depends on what happens with the ceasefire and whether the war restarts. Again, to the extent we have shortages in fuel, jet fuel, if the war restarts, for example, that could impact traffic again in terms of flights. Historically, we've seen that snap back very quickly. We looked at what happened in COVID. Traffic rebounded very, very quickly across toll roads and airports. The long-term impacts are limited to the extent of the war, duration of the war, ultimately. Supply chains will take around 4 to 6 weeks to correct themselves, based on my understanding of logistics supply chains in jet fuel and crude oil. So again, not huge impacts there. Longer term, again, we wouldn't expect to see much impact at all to utilities, to infrastructure more broadly. The dynamics haven't changed insofar as people are still going to need power, people are still going to need water, people are still going to travel. Even if we get into a recessionary scenario in the most extreme events, similar to the 70s kind of fuel shock crisis, the kind of companies we invest in are very robust. Demand destruction is very limited in these companies, therefore will perform absolutely very strongly in an underlying sense and relatively strongly in a stock market sense. We'll also see some opportunities opening up here. So particularly for electric utilities, where we had the renewable theme really driving markets a couple of years ago, we still see that presenting opportunities even now, despite the fact Trump's pushing strongly against it. But if you're in Europe and you see your vulnerabilities to reliance on Middle East energy, this will probably help accelerate or push the desire to accelerate the move away from fossil fuels and certainly reliance on Middle East sources of fossil fuels where possible. That means more investments in renewables, more investments in grids, and more investment in the electric cars from consumers to take away that risk. All that requires investment on behalf of utilities. That really presents opportunity for those companies.
Thanks, Ofer. And thank you for watching. If you'd like more information on the Magellan Infrastructure Fund, please visit the Magellan Investment Partners website. Thank you.